things actually were pretty bad already. And then I want to just reflect a little bit on what the future holds for us in that context. And I think that's the important part of it. Now, of course, we can't go into great depth in doing this, but this is, if you like, just a taste of my thinking and how I understand what's happening.
Hello.
And I do this mainly in the context of an investor.
I have requested everyone to log in at least 15-20 minutes so we can fix it. What is your name, please?
Hello. Niroshi, I can hear you talking to me. Are you talking to me or? Okay, I'm continuing. So what I have to say sometimes offends people because it doesn't fit the narrative that they need for their business or whatever. I actually don't apologize for that. I'm actually telling it to you on the basis of the way I am investing my own money in this situation and the way I expect to invest it going forward. So this is not actually going to suit those people who need a different narrative. I think you can get that from most of what is available in the general media out there. This is likely to be something that you may not have seen, and it guides me in trying to understand what's happening and what's going to happen going forward. Okay, so with that, let me just say, this is, we see now, I think by now, everyone has been frightened by the data. So this is some of the data you may have seen already. The Financial Times came out with this just a few days ago, telling us that most of the purchasing managers' indices, this is an indication of where manufacturing activity is going, is already lower than it was at the height of the 2008-9 global recession. So this is, if this is any indication of what's likely to happen, it's not very good. This was followed by, day before yesterday, the IMF giving us its own predictions. And this is the interesting part of what the IMF is saying, that they're saying that this year they expect, so it's this one, global economy to be in recession by roughly -3%. And then the good news from the IMF is, of course, that it's going to recover again next year. The advanced countries are going to be badly affected. The emerging markets and developing countries less. So you can see roughly -1. And there, Asia is supposed to come to 0. And the other emerging markets and developing countries significantly lower than that. But the advanced countries will be hit particularly badly. And according to the IMF, the worst affected will be the United States, worse than the other advanced countries. Okay, that's what we see up to now. And now, this is what I have been looking at for quite some time now, prior to the coronavirus outbreak. The first thing I can show you is that in January, the Financial Times, we also have the same data, the Financial Times produced this chart. And what the Financial Times was telling us is that the growth of global industrial production, okay, so that's the green line, was actually falling off a cliff. They were saying that global industrial production was incredibly weak, and in fact, so weak that they were suspecting something pretty bad was about to happen in the global economy. Okay, so the article already was there before the coronavirus struck. The second thing that we saw was a number of studies showing that profits growth was fairly weak already going into the coronavirus, and that is here. This is profits growth. This is a moving average of 5 years, because otherwise the volatility distorts everything. So what we see is that it was already weak from late 2018 going into 2019, was already extremely weak. But the two things that really require attention, the first one, repurchase agreements, repos we call them. These have always been a very, very good indicator of any serious trouble in the global economy, especially the US economy, because the US economy, its financial markets dominate the world. So whenever something happens in the world economy, the US financial markets already feel it. And the market that feels it the most is the money market. Now, a repo, for those of you who don't know what a repo is, the meaning of it is a repurchase agreement between mostly commercial banks and the central bank of the United States, the Federal Reserve. What happens in these instances, so you see in 2001, again in 2008, and now last year, I'll come to that in a minute. What happens is there appears to be a major rupture in the economic system. Companies are having great problems with liquidity. They basically can't sell their goods. When they can't sell their goods, they're desperate for cash. They go to commercial banks. The commercial banks don't have enough cash, so they go to the money markets and they demand this money from the Federal Reserve. The Federal Reserve initially doesn't grant that, but when repo rates, interest rates on money market funds rise sharply, the Federal Reserve then provides that extra cash. So this is what we see here. This is the volume of repos, the volume of repos. And that's very large. This is on basically a monthly average. Is it the monthly average? So incidentally, I'm joined by my son here. All of these charts are his charts. So if anything is wrong, we know who to blame, don't we? Okay, it's him. Bro, say hello. Okay, Bram is saying hello to him. Okay, so what we then saw last year, and this was in September of last year, something really strange happened. It went like this. In September, we started to see repo interest rates spiking. They went from somewhere in the region of 1.5% to 10% in a matter of days. Obviously, something was wrong. Then what happened was the Federal Reserve came in and announced that there were some problems in the money markets and they were dealing with it. And they said that that requires us to do repos worth of somewhere like 10 billion a day, $10 billion a day. About a week later, they said that this repo accommodation would last for a month, but we have to raise it to 20 billion a day. A couple of weeks after that, and now we're going into October, they came with a new announcement saying that, in fact, our 20 billion is an underestimate. We need to issue 40 billion a day, and it'll have to go on till the end of November. This is followed by yet another announcement a week later where they raised the daily issue to 60 billion. And so this went on like this. And then they said, okay, we will do this till the end of the year. This is end of 2019. Meanwhile, they kept raising the amount that they had to put in. Now, these were starting to get to levels that nobody had ever seen before. And it started to make everyone really nervous. Because what this meant is, and this was already said in some of the informal financial market sites, it was rumored that one of the big American banks had gone bankrupt, belly up. In fact, several of them thought it was Morgan Stanley and JP Morgan, sorry. And in fact, even wrote about it, saying that JP Morgan had exposures to WeWorks and a number of other companies and basically had gone bankrupt. These were just rumors. Nobody discussed it in the formal press. So you didn't see it in Bloomberg's or Financial Times. But in the informal media, the one that is actually read by most of the people working in Wall Street, this was actually rife. And this would then explain why the repos were absolutely out of control. In January, they then came with the very last announcement saying that they would be doing 120 billion a day, and it would go on till the end of May. I mean, this obviously meant that there was something so big, because remember, in 2008, the problem was Lehman Brothers. But now you are talking of a bank. If JP Morgan was really the bank in trouble, this is basically 50 times Lehman Brothers. And this means that we are talking about a fallout that was much, much bigger than 2008-9. Now, this is all before the coronavirus. Okay? It had nothing to do with the coronavirus, but it was there. And generally, everyone was nervous, but they thought that the Fed had it covered because it was doing somewhere like 120 billion. I think the last figure that they quoted was 150 billion, wasn't it, a day? However, there were many people in the market who actually had the feeling that even 150 billion a day was not going to cut it. That this was so big, it required something which was astronomical. We also had a second thing appearing at the same time. This was remarked on many, many times by many individuals because it's actually the best indicator we have of a recession. And that is what we call the inversion of the yield curve. It is when short rates basically rise above long rates, okay? The long rate we take is the 10-year government bond rate and the 3-month government bond rate. Actually, they call it the treasury bill rate, okay? So this is the one that is considered the best single forecaster of a recession. And in this case, a recession in the US, which has in the past translated into a recession in the world economy. So you can see, in fact, there are many charts on the internet that show this going back right through to the end of the Second World War. And there's only one example, and even then there's some doubt about the validity of that. There's only one example where this hasn't been the case. So what we see is 2 or 3 very, very strong indicators that we were not only going into a recession, but it was going to be the biggest recession that we have seen in modern times. The question is, what was happening? Because if you want to know what is likely to happen going forward from this point, you should know what was happening then. What was happening then? Why was this giant hole, and we sometimes refer to this as the black hole in financial markets? Why was this opening up and gobbling everything inside? The only way you can answer that is by understanding business cycles. And as I've often remarked, this is something we rarely teach at universities. However, it is probably the most studied thing in Wall Street, because this is actually how they understand what is happening in the world outside. They don't use any of the textbook economics that you're taught, because they know by and large it's a waste of time. But they use this, and they pay very, very large sums of money for those who understand this and can translate it into something that affects their business practices. So in Wall Street, it's largely trying to understand where interest rates are moving over the cycle. Those of you who are not familiar with the cycle probably haven't attended any of the sessions that I've been giving in Sri Lanka, because they always begin and end with the cycle. But for those of you who haven't attended, the cycle, the economic cycle that we refer to, is a period of expansion. So here we have a period of expansion in economic activity, followed by a period of contraction. Again, expansion, then contraction. This is continuous. We understand, and most of us who have studied these things, and that includes basically most of Wall Street, they split the cycle into 2 different types. The type that is publicly broadcast is what we call the juggler cycle. It's this shorter cycle, 7 to 11 years. We have records of about 47 of these in total. And the we I refer to is actually the US government. The US government even has a dating of these cycles. So the things that you saw earlier that I was referring to are actually taken from the National Bureau of Economic Research. They date these cycles. And the one thing that we know about these cycles is, by and large, from the bottom to bottom, it's 7 to 11 years. Now, we have seen that a lot has been made in recent times of the fact that this present cycle has gone well beyond this period of that it was supposed to go into a down. And many commentators were commenting on this. I come back to that in a second. The other cycle, which we don't actually talk very much about, is what is called the Kondratiev wave, the K wave, the long cycle. And that is a cycle that officially is dated as lasting between 50 and 60 years. But when you look at individual cycles, the variation is much greater than that. The Kondratiev wave takes the form of these long waves because they're triggered by major clusters of innovations. And the shorter cycles, they're triggered by changes in reinvestment of fixed capital, the machines and the factories and so on. But these, as we will see in a moment, are the result of these sorts of major technological changes. Okay, so we have all of these major technological changes associated with these. Probably the best exponent of this long cycle was an economist called Schumpeter, Joseph Schumpeter, Austrian by birth, but resided in the United States in later part of his life. And he paid a lot of attention to empirical details of these cycles. And roughly, this is the dating that he left us with. And of course, we have now added to that because Schumpeter died many decades ago. But now we have, so you can see here, major technological changes. And one of the interesting things about these long cycles, they tend to be dominated by one major economic power. So, sorry, let me go back. The power that dominated for a very long time was the UK, and it gave way to the United States. Now, currently, many people who follow the long cycle believe that the center of the economic universe is now shifting to East Asia, to China and East Asia, and they will come to dominate the cycle in the future. Of course, a lot of people don't like to say that because they like to see the world economy as still dominated by the Anglo-Saxon elites. So they find it very difficult to accept China and East Asia could possibly dominate the world economy. These are people who actually don't know world history, but in fact, Asia dominated the world economy for 2,000 years before Britain did. And, you know, as many people have written in recent times, this is actually just a reversion to what it was before. But okay, that's a by the by. What is important to notice that the shorter cycles, the ones which have a 7 to 11 year duration, these cycles move around the long cycle. Can you see this? Okay, so what we see is that the shorter cycles actually have an interesting pattern that reflects where we are in the long cycle. When we are in the upward phase, the shorter cycles have much longer upward phases and very, very short down phases. In fact, around here, the tendency was for many forecasters to say the cycle is dead because the down phase was so short that it had virtually not much of a manifestation. Today, we see the opposite. We see that the down phase is much longer than the up phase. And if you ask a lot of people in the business world, have we actually emerged out of a recession, out of the 2008-2009 recession? They will say, no, you know, the economy is still pretty weak because recovery is very, very weak. It's very weak. The good news is, of course, that if one believes in cycles, one should believe that in the end, we should move upwards again based on this new technology. The internet, biotechnology, and especially, so for many people's money, it's robotics, which is going to be one of the major drivers of this new upwave, where in each case, what happens is the way we produce, the way we consume, our households, everything changes dramatically. Today, we take the motor car as given. Every family has one motor car in the advanced countries. And in urban areas, in developing countries, most families have a car. But in, let's say, going back 100 years, this would have been unthinkable. We could never have imagined that. It's the same that we see today with robotics. We actually can't imagine how it's going to change everything, but we're already seeing the changes taking place. We can see these in factories, but they're also coming to the household. It's estimated by people who are watching robotics development that Japan will, within the next 5 years, have a robot that will actually be functional in the kitchen, in most Japanese kitchens. Within 10 years, the robot will actually take over most of the domestic duties. This is the current thinking. What this means is we will undergo another major change. Okay, where does this leave us? Well, it leaves us with this, that according to this diagram, we are here at the bottom. And at the bottom, some very, very bad things tend to happen. Because the economy is so weak, governments tend to run huge budget deficits. Governments tend to reduce interest rates to the lowest levels they can possibly reduce them and expand the lending to businesses and individuals. Basically, the economic activity is not very strong in this period. It's extremely weak. Let's have a look here at a typical cycle. So this is actual data we use, and we use the United States because the cycle is clearest in the dominant economic power. We can see that the best way to indicate a long cycle is with the trend in inflation and the trend in interest rates. We see that in the upwave of the long cycle, as growth picks up, as economic activity picks up, so does inflation. And in the downwave, as economic activity weakens, so does inflation and so do interest rates. This is the thinkings. We're talking about very long periods of time. Officially, this is termed a bull market in bonds. It's actually been going on for nearly 40 years. This is one of the longest running bull markets in bonds ever seen. This means that one of your best investments at this point would have been buying bonds. You would have made more money on bonds than any other single investment that you could have made, i.e., you wouldn't have made as much in equities, nor in gold, nor in property. Bonds would have beaten all of them. Now we saw that as we came near the bottom, governments started to do, and have done in the past, fairly crazy things. But actually in this recent past, they have been able to do even more crazy things than normal. One of those crazy things is to reduce interest rates to very, very low levels. And we can see in the last phase of this down, that interest rates have been taken. So this is the short-term money market rates. We take the 3-month LIBOR rates, London Interbank offering rate, as the benchmark. What we can see is in some countries, Japan, the Euro area, this rate has actually been negative for quite some time. In other countries, like the United States, was high, and then it's been falling very rapidly of late. Alongside a fall in money market interest rates, there's been a massive rise in the quantity of money printed. Why this is important is for those of you who have ever been unfortunate enough to study economics at university, you will know we taught you, we drummed it into your head that the worst thing that could ever happen is for governments to print money. Okay, but what we found is somewhere around 2008, 2009, in the middle of the last global recession, governments got it into their head that printing of money was the only way they could save the system. Here are 5 central banks, the largest 5 central banks in the advanced world. In fact, they're the largest excluding China. I've taken China out of this. I'm just putting the 5 large central banks, and that is the European Central Bank, the Federal Reserve, the Bank of England, Swiss National Bank, and the Bank of Japan. Okay, so we're going to see here that as a percentage of GDP, can you see this? We were hovering for actually a long period at between 10 and 13%. Before this, incidentally, it was between 5 and 10% for about 40 years. This is the cash in the system, the physical cash, relative to GDP. And we were always teaching our students that if you increase that, you get inflation. And when this was initially increased, most of the economics profession, and we have quite a number of them documented, forecast we would have hyperinflation. Which also begs the question why the central banks did this crazy thing. Not only did they raise it then, but they kept raising it constantly right through to the present. And in recent times, the Federal Reserve of the United States added $2.2 trillion in just 6 weeks. That is 1/3 of all the cash outstanding they've added in just the last 6 weeks. In other words, they do not see any problem with printing to infinity, if you like. This, of course, changes everything in our understanding of economics, as this has done. This has done, because actually taking interest rates to negative territory is supposed to be a disaster. Is supposed to be a disaster. We have always taught that. But for some reason or another, the monetary authorities, the governments of the advanced countries, felt that they had no other choice. In the same way, they felt they had no other choice but to flood the world economy with all this cash. Then they did a third thing, which also baffles many people and beggars belief. They started to get into large budget deficits. You can see it started in 2008-9, receded somewhat, but then 2015 onwards has been rising non-stop till now. And of course, given what we have seen in the last few weeks, this is going to shoot up even further. Again, the question has to be asked, what has been happening? Why are they doing these things? One of the things, again, that you will note, those of you who have done the economics courses, we have always told students budget deficits are bad. And we haven't told them budget deficits for developing countries are bad. We have told them budget deficits for any country is bad. Yet they've now been silent for a long time And today we hear academic world shouting, more budget deficits, more budget deficits, more printing money please. Okay, so obviously all the things we used to teach have been forgotten or deemed to be wrong. Now we seem to be in a new world where, for some reason or another, these are all considered to be accepted practice. What is the problem? Let me take you back here. The problem is we are at the bottom of this long cycle. Economies are weak. People ask me the question, but how is it you can say the US economy, for example, is weak when unemployment until very recently had hit the lowest level for 47 years? Surely that means that the US economy was very strong. No, what it means is the US government fabricated the data. They did it starting in 1995. Now, immediately people say, oh, conspiracy theory, conspiracy theory. Sorry, it is not conspiracy theory. It is simply that academics especially and others take for granted whatever the government gives them by way of statistics. If you bother to actually look at those statistics, you will realize they're garbage. I refer you to a site called Shadow Government Statistics, where the person starts to actually go through how the US government now calculates the unemployed. How does it actually calculate those in employment? Let me just give you one or two examples. You can have a situation of a person deemed as not unemployed if they have been looking for work for more than 9 months. If you have been looking for work for more than 9 months, the assumption is that you have chosen to be unemployed. So what they do with this is they take everybody who is unemployed for more than 9 months off the register. You know these weekly figures where we see 150,000, 200,000 increase in employment? Well, those figures include anybody that does babysitting for 1 hour a week, even if they don't get paid. So if you go and do babysitting for 1 hour a week, you are deemed to be employed. The funniest thing with all of this is that Donald Trump pointed to this before he came to power. He actually said in many television interviews, he said the unemployment figures are a joke. He said the real unemployment rate is about 20% in the United States. This is in 2016, because actually somebody had shown him these charts where this man, John Williams, who runs this site, simply computed the unemployment rate as we used to compute it before 1996. If I compute the unemployment rate as I did before 1996, meaning that anyone who can't find a job is unemployed, then I would have 21.2% as of October 2018. That means the vast unemployment levels of the 1930s actually were already with us from 2008-9 onward. They never got better. Trump, of course, after he became president, he went around saying, you see, unemployment is the lowest it has been in 47 years. He seemed to have forgotten all the interviews. You can go back and see his interviews where he said, unemployment is above 20%, I'm going to do something about it. Okay, the economy is weak. Interest rates have been dropped to historic lows. One important consequence is that global debt has just skyrocketed. We could go through this in greater detail, but no time now. What we can see is that it's not only advanced countries, the blue area, but it's developing countries are getting more and more into debt, even relative to advanced countries. But the debt is just rising, rising, rising. We have figures going beyond 2016, where we have figures up to 2019 now, Bram. What is the total? Do you know?
It's now 280.
It's now 280% of GDP. Of course, these are levels that we have never seen before. Some countries like Japan are even higher than that, around 500%. So Japan is around 500%. Basically, this has meant that debt has been one of the ways we have been fighting this downward phase of the long. One of the consequences of what has happened with all this printing of money, excessively low interest rates, has been what we call a massive financial bubble. It started with Alan Greenspan, the Federal Reserve chair that retired in 2005. Alan Greenspan really started the huge printing of money and the massive reduction of interest rates, which resulted in basically an upward movement of stock prices that hasn't stopped yet. Not only upward movement of stock prices, but also property prices, any asset price you can name, it's risen dramatically. We are now at levels of asset prices to GDP that we have never seen before, and we will never see again, in my view, except in a hyperinflation environment, which is always possible, but which cannot continue. At least it cannot continue with any degree of of economic stability. Okay, there's a lot more data and information that we have because this requires much more analysis of the long cycle and the shorter cycles. But my job here was to tell you there's something underlying what we see. What do we expect? Okay. I told you at the beginning that virtually everybody is forecasting massive recession, massive unemployment, services sectors in particular being very hard hit. I'm not sure. I'm not sure. I think there can be a recession and there will be weak economic growth, but I'm not sure it's going to be as devastating and bad as the forecasts suggest. So that's the first, that's the short term. That's the short term. Let me just show you. So the reason is this, that every time there is a recession, there has been a global stimulus or the stimulus by one country. So in 2008-9, basically the US, China, and Europe got together and ran huge budget deficits, taking the world back out of recession and actually above previous growth rates. We had the 2012 recession because of the European debt problem and because of the tsunami in Japan. That resulted in Europe and Japan running budget deficits, taking us out again. Then we had in 2015-16, maybe not known to many people, but we actually had a global recession affecting most countries, but not causing the US to actually go into recession. US avoided it. They had 0.5% growth. But China went into recession. However, the official data of China said that they were growing at 7%. Now the Chinese have admitted that they did have a recession in that year, and it was probably a growth rate of around -4%. The Chinese reacted by running a gigantic budget deficit and spending masses of money on infrastructure. They took not only their economy out of recession, but they took the whole world economy up. Now we've been going down, down, down. We have the corona outbreak, and we have many countries committed to huge government stimulus packages. We have budget deficits, and we have huge printing of money, reduction of interest rates. This should actually, once the lockdown ends, this should cause a major recovery. The reason why it should do that is because this level of contraction is not a normal level caused by declining profits. Profit rates were falling, but it usually takes some time for the whole economic system to fall. When that period of time is accelerated, then it means that actually the recovery can be very, very quick. You see here, we had a very quick recovery because everybody went in with massive stimulus and massive printing of money. Here we have roughly the same. It's likely that we will go down a bit here and then recover very fast, very fast. At the very least, by the end of the year, it's quite possible that you have major recovery in the world economy. Certainly, you can see some of the figures coming out of China that their industrial production is already starting to recover, isn't it? Ram, you've seen those figures already? And the same will happen with the other advanced countries. Okay, what you should have is some balance of payments problems and some weakening of currencies in developing countries, because this normally happens. See, 2008, 2009, we take countries like Malaysia, Philippines, etc. All developing countries are export oriented. In a global recession, exports collapse, and the country's current accounts usually collapse with it. So you can see the two columns indicating that collapse. And with that collapse go currency depreciations. My view is that this may not be as bad this time round as 2008-9. In other words, this year and next year, we may not see that same collapse. We may not see that main collapse. However, and this is the however, I am not sure what happens beyond that. So in 2021-22, if I'm right, and if all that happens is now we add to the debt problem, we add to the financial bubbles, but nothing is done to restructure the economies in any fundamental way, we're back to square one. Not square one, in fact, the problems are going to get worse. You could see that this time round, when the markets started to disintegrate, the amount of money the Federal Reserve had to put in was colossal. There's no reason to believe that next time round, it won't be even bigger. And what we could also see, and this is where we're likely to get very, very big problems, is it could be very much worse, because one of the things that could be starting to happen is the dollar as world money, well, loses its status as world money. At the moment, the Fed has been able to do what it did because the dollar is world money. But once dollar loses that status, it's quite possible that this cannot be done to support the global system, in which case we are in more trouble than we otherwise would have been. Okay, I think that's about it. We've had 50 minutes. Okay, that's it, guys. Niroshi, do we have some time for questions?
Yes, we do, Doctor. So what you can do is, we are not going to unmute everyone. If you can type your question on the chat option, the doctor will take it.
Where do I see that?
So when you go to go to your screen, Doctor, before share screen, you will see the option chat. So click on that and then you can see what the participants are typing.
This one?
We can go back to the Zoom.
Oh, okay.
So you have one question until that.
I'll stop that and then, is this it? Okay. Is this one, is there any sign of post-COVID world would be moving to an economy from market-centered to people-centered, result in socialist economic principles? Answer is, I don't see that tendency at the moment. One of the things that I feel has happened, which is very, very unfortunate, is that the opportunity has been taken by governments to actually feather the nest of very rich elites. You can actually read that in the Financial Times today, article by Gillian Tett. Of course, that's not what she says, but she says the danger is that all this stimulus is actually just going to raise financial markets again, and financial markets will be fundamentally benefiting the rich. At the moment, I don't see that changing at the moment, but of course, we could see a world where there is a lot of unemployment and people are very unhappy that all this money has been channeled just to the very rich people and nothing has been actually given to any of the unemployed and people who are going to lose their small shops and small businesses and so on. In fact, of course, we already hear that, but those rumblings could get worse. Shall I take them in order? So this is the next one.
I think there was a very, the first question was a very specific one, Doctor.
Which one?
What do you think about Sri Lanka economy?
Well, I wish I knew. All developing countries are basically having problems at the moment. And Sri Lanka is no exception. Somebody sent me some articles in the newspaper saying that the government has just gone back on the tax breaks that they gave, the PAYE tax, etc., etc. I think most of the developing countries are just trying to survive. The future, if you're talking about the future as the longer term future, I think this, for me, still depends very much on the government's economic strategy. For those of you who have attended any of the sessions that I have had in Sri Lanka, you know that There's only one thing I think the government has to do, and that is go for export-oriented industrialization. We now have many people saying, oh, but this is old hat, this is old stuff, etc., etc. No, sorry, it's not old stuff. It's just that there's a lot of propaganda against it. And there would be propaganda against it because it's not in the interest of the system to have more East Asian success stories. So anything we can do to stop any country moving down that line, we will do it. You know, we will come with all sorts of excuses why Sri Lanka can't do this and why, etc., etc. It can. If Rwanda can do it, Sri Lanka can do it. Okay. If Vietnam can do it, Sri Lanka can do it. It's a question of leadership. It's a question of understanding what is important. I'll tell you this, as soon as Sri Lanka does it, they have my money. Which was the next one? Sorry. If the US dollar loses its value as the global reserve, what do you think will take its position? Well, in the last presentation I made in Sri Lanka, I said that I think what's going to happen is we will have some gold-based international world money. It can be a basket of currencies linked to gold. At that time, I remember people were saying, no, that's impossible. We will never do that. This is a harebrained thing. No, I'm sorry, it's not harebrained. You can even see that this is what's happening when you see what's privately being done with a lot of the reserve holdings of many of the central banks of the world. They're starting to amass gold in a large way. For me, the most significant of all of them was when Germany asked the Federal Reserve to transfer its gold holdings to Germany. I think something is going on. China, Russia, now Turkey, many countries are starting to increase their gold holdings. I don't think China wants to have the RMB as world money alone. And I don't think the Europeans want that either. So I think the only thing we're talking about is a basket of currencies with fixed exchange rates to one another, linked to gold, where there's an agreed basis for changing those exchange rates. And incidentally, that was actually a proposal of John Maynard Keynes at the end of the Second World War. That's actually what he wanted to see, not the dollar-based system that we have. Is that okay? Countries like the USA talking about moving their supply chain back to USA. Also other countries in the EU like France. Yeah, okay. I think that's true. I think it's true that countries are reorganizing their supply chains, but I doubt very much if they're going to bring production back to their own countries in a big way. I think this is the moment that new production powers emerge. And there you can see a lot of production moving to countries like Vietnam, Indonesia, Philippines, etc. I wouldn't be surprised to see production moving to other parts of the developing world. I have said for a long time that crises like this and the other one that is likely to follow this in a year or 2 years are good opportunities for developing countries to attract more and more production to their countries. But for that, you need to be set up and you need to have all the incentives put in place, as well as having the structures to take advantage of it. Next one. What is your take on investors moving from conventional financial markets to digital currencies, crypto? So for me, I make a distinction between e-payment systems and cryptocurrencies. For me, there is no chance in hell of cryptocurrency being world money or money in any country. And the reason is because there's no chance in hell of us using a cryptocurrency to price goods or denominate debt. These are the two most fundamental things of any money. It doesn't mean to say crypto cannot be used as an asset. Most certainly it can be used as an asset. And I think a lot of people who thought that Bitcoin was going to be a great investment because it's going to be money have now changed their mind and said, no, actually we're having it as an investment. It's a good way of avoiding taxes up to now. Up to now, in the future, you won't be able to do that so easily. And it's a good way of being able to, let's say, bypass controls on asset prices, which you have, for example, in the case of gold. If you look at the gold market, it's manipulated. Now it's not a conspiracy theory, it's not a discussion point, it's actually officially manipulated. You can see that from the premium on the price of gold and the fact that all these people who haven't been able to settle in physical gold are not being prosecuted. They're not being prosecuted because they were told to manipulate the gold price. Bitcoin, less susceptible to that manipulation. So if you like, Bitcoin and other surrogates of gold will emerge and they could reflect the asset price movement of gold as it should be. So I think that part I don't have any problems with. What else have I got here? Sorry, they're going very fast. Lanka has become consumers, FDI is capital. Oh, sorry, where are we?
There's a question on
this one. What would your advice be to developing countries like Sri Lanka at this moment? At this moment, batten down the hatches. At this moment, you actually can't do too many imaginative things. You have to make sure that you are not hemorrhaging foreign exchange. So the most important thing that a country like Sri Lanka can do at this moment is not to hemorrhage foreign exchange. At this moment, I heard that the government is going back to the IMF for a short loan, a short duration loan. I think that's unavoidable. But if you mean what can Sri Lanka do over the longer term, well, I already mentioned that. It's that export-oriented manufacturing strategy. People say it's not easy for Sri Lanka to do, et cetera, et cetera. I've had those debates and discussions. I'm sorry. I think it is, it can be done, it should be done. It's just that there's too much skin in the game. There are too many players, too many pressures trying to stop Sri Lanka doing that. But I guarantee you this, I will stake everything that I have on this. If Sri Lanka tomorrow adopts an aggressive export-oriented growth strategy, Sri Lanka will have a minimum of 10% growth a year for the next decade. Sri Lanka will attract huge quantities of foreign capital. I guarantee you, I will put all my money into Sri Lanka if Sri Lanka does that. That's how confident I am. Everything else, sorry, it's all bullshit. It's bullshit because it's people who have too many other vested interests. There's only one thing that has made countries successful. We know it. We know it. You know, everything else is simply bullshit. It's simply bullshit. You know, it's pragmatic politics, it's this pressure, it's that pressure. Sorry, you know, but I only vote with my investments. I don't have any skin in the game. And I'm guaranteeing you that that is the only way forward for Sri Lanka. Is there a possibility of creation of budget deficits, stagflation instead of growth? Yes. yes, there is a possibility. Because one of the things where we have observed, and it's actually not we, I can't take the credit for this, it's the Bank of International Settlements. They have a very interesting chart and they keep updating it regularly. The BIS, Bank for International Settlements, they show that increasingly you have debt buying less and less growth. Okay, so let's say 30 years ago, increases in debt bought a lot of growth. But in the very recent part, they hardly buy any growth. Now, budget deficits are basically the government's way of increasing its own contribution to growth and accumulating debt as a consequence. And I think you're going to see that the budget deficits will result in short-term gains, but very quickly the growth rate will fall again. Okay, and that's more or less what you're going to see. I think we cannot avoid a major structural change of the global economy if we're going to get going. And I'm not the only one that says this, so I'm now in very good company. I think everybody now is talking about only one thing that needs to change, one thing, the dollar. The US can no longer have the dollar as world money. It's the dollar that is blocking everything. It's the dollar that is blocking the US economy. It's the dollar that is blocking the world economy. The dollar has to go. And if the policymakers of the world really understand what's going on, they would be getting together now as I speak and talking about how to end the dollar's role as world money, because that is one of the single biggest blocks to everything. It's also creating a perversion of the US economy, which has now gone on very, very far. How realistic is the global growth rate forecast of -3% for this year? Well, yeah. You know, the problem is, I don't think any growth forecasts, as long as I can remember, have ever been realistic. Okay, I think all you can say is what is likely, what is the tendency likely to be? I think there'll be weakness in the next few months, but after that, there'll be strength. And it'll be basically very short-term strength. So I'm not even sure the -3% for the world economy this year will materialize. It could be, you know, maybe -1%, maybe not any minus at all, given what has happened. But does this mean to say we're out of the woods and everything is going to be fine for the next 7 to 11 years? Answer is no. Answer is no. We've just bought a bit more time at the cost of much more debt and a greater financial bubble. That's all.
Massive unemployment, how we can solve this and how the government can.
Yeah. Unemployment, yes, there will be a very big increase in unemployment. How can the government solve this? I'm not sure they can solve it like that. If I look at the real unemployment data, let's say for the advanced country, that has not been good. The countries where unemployment has been the lowest are the East Asian countries. Okay, the solution is production, basically. This is the solution. Problem I find is that many developing countries are captives of the advanced countries, and they just produce for the needs of the advanced countries, so that a lot of their populations are essentially underemployed if they're even employed. I think each country has a duty to solve its own problems. There are global problems that also need to be solved, but in this case, again, I go back to, in Sri Lanka, you have to get production going again for employment to be solved. And, you know, it's not good enough just to have people employed. I think they have to have a future of higher wages, you know, that is employment with remuneration, not employment as slave labor. I think you have to have a system where that is built into the growth process. And again, there's only one that I know of and one that has ever yielded anything like a rapid rise in living standards, and that is manufacturing-based growth. You said there is a possibility of collapse of JP. I think the problem is this, that you always, whenever you come to the end of these shorter cycles, you get ruptures in payment systems. This means that some companies cannot meet their debt obligations and they actually don't have the liquidity to survive. So then they go to the banks. What has been happening in the last 10 years is the rise of what is called zombie companies. You may have seen this statistic, it's been bandied around a lot, but 40% of American companies are what is called zombie companies. They have basically no net asset worth. They live on debt. And this is the problem of the low interest rate environment. It has encouraged the growth of zombie companies. Indeed, today in the Financial Times article by Gillian Tett, she again referred to the fact that the problem of what the Fed is doing is they're encouraging more zombie companies, more zombie companies. Now, what this means is that a lot of companies are always existing on the edge. So JP Morgan just happened to be lending to quite a large number of very big zombie companies like WeWorks and what's the Chinese company called Luckin, isn't it? The coffee company. And those companies basically went belly up, but they're so big that they created a gaping hole in JP Morgan. So what the Fed did, if you see what the Fed put into the markets, it's $2.2 trillion, 2.2 trillion. We're not talking billions anymore, we're talking trillions in 6 weeks to save the markets. Now, this has never been seen before. This is not a sum of money that anyone in their wildest dreams believed, but this they knew they would have to do already in December of last year. They knew that. And that is incidentally why, who was the one who got the heart attack? Was it the head of JP Morgan? I think that's why he got a heart attack, because he suddenly realized that everything had gone. But, you know, basically the Federal Reserve found a way to justify handing over, I think they handed over somewhere like $750 billion to JP Morgan, you know, and rescued that one bank. That's my rough guess, but I just obviously no one is ever really going to know. However, I have a feeling that this has been discussed with bankers all over the world. I have a feeling this was discussed in December of last year because it was so big. The problem was so big. You saw the data, and that data has actually been published by the Federal Reserve. And that data doesn't lie. It was a massive amount of money, and the money was getting bigger and bigger. So my end conclusion with this one is that essentially this doesn't solve that problem, and it is very normal that that type of thing is going to happen in a low interest rate environment. Again, this is not me alone, but it's others who are saying the same thing. The FT article, sorry, just the FT article is by Gillian Tett today. You can go to the internet version of the FT and just type Gillian Tett and you will see she's basically questioning what the cost of Powell saving the financial system is going to be. She says he had to do it, but then as you go down the article, you can see she is worried that it's actually again going to make the financial bubble bigger and more zombie companies. It's Gillian Tett, T-E-T-T, Tett. Is the yuan the ideal currency to hold your positions post-corona? Yes. For me, all strong currencies are always ones that reflect strong production bases. So if I look at the euro, I think it's probably the most undervalued currency in the world, even more undervalued than the yuan. And that is because the country with one of the largest trade balances, and this trade balance has been going on for a long time, is Germany. The euro as a whole has a very large trade balance. And currencies always go over the long term with trade balances, always. There's actually no exception to that. So I would say that if you believe China is going to become one of the strongest economies in the world and maintain its trade surpluses, yes, I would hold yuan. You would have been very wise to do it over the last 15 years. I think going forward, I would diversify. Yuan is one, but I hold some money in euro, and I'm also holding money in Vietnamese dong, Vietnamese dong. Because I think Vietnam is also going to be a very, very powerful country in the future because it's all production for them. They've suddenly turned the screw. Everything is production for them. You know, you can see even during this coronavirus shutdown, they didn't really shut down all their production. They shut down restaurants and this and that and the other, but not their production. Their production kept going on.
Doctor, there are a lot of questions coming in. So we will take one last question. Sure. And I will send you the other questions, given I know you have a busy schedule. Let's see whether on email, whether we can respond to the other questions.
Could combine these.
What I would, what I will do, just to let you know, is I will cluster some questions together, write one email and send it to you, Niroshi, okay? But the last question I will take is about tourism and the global airline industry. Well, I think their tourism, for me, will take much longer to recover, like many service industries, because of the fear element. The fear element that is there, people will not want to travel. I know, for example, I can bet Chinese will not travel very much because they are now panic-stricken about leaving their own environments. I think the airline industry, what is likely to happen is consolidation in that industry. It anyway should have happened long time ago, but this is likely to be one of the consequences, that there will be more consolidation because, again, recovery of passenger travel may not be, I'm not sure because I'm not an expert on those things, but I'm just guessing it's not going to be so quick because there are still likely to be lots of checks, you know, going onto airlines, going to different countries, you know, have you visited this country in the recent 3 months or blah, blah, blah. Okay, so I think their tourism could take some time. Airline industry likely to, of course, be problematic with lots of consolidation. Sri Lanka's tourist business, well, there I now express hope rather than any genuine knowledge. I just hope that that Sri Lanka's tourist business revives in the not too distant future. It's difficult. I mean, I just don't know those things well enough. your guess is as good as mine. Okay, one and all, again, sorry for not being with you for many reasons. It's a long time since I've been to Sri Lanka, but I'm hoping to come that way in July, and I look forward to seeing many of you then and talking at greater length. That's the thing I miss the most. You know, one of the things that I tell many people is whenever you go to Sri Lanka and meet, you know, go to any audience, everyone has opinions. Everyone is not frightened to express them, which is actually one of the great pleasures I get in addressing audiences, because people disagree with me publicly and they have their own views and so on. It's great. It's great. That's what I miss a lot with all of this. So when I come back, I'm looking forward to picking up with that and having your disagreements with me and learning from you with all your comments and questions and so on. Okay.
Since you mentioned about your travel plans in July, we are doing, CA Sri Lanka is doing a few exciting programs with Dr. On short courses, which we are starting in July, and we are looking at doing it in a blended version as well, whether we can do some virtually. So we are looking at all that options.
Yes, I should actually say something about that, Niroshi, because one of the things with this presentation today is it's very useful to have a full session where you get much more of the argumentation and the facts. Because one thing that bothers me today is we accept too much unquestioningly. We don't ask someone, so why are you making this forecast? You know, recently I was looking at the Rabobank making a forecast. And in the annex, they told me how they got to that forecast. And, you know, frankly, I was appalled because they were using some general equilibrium nonsense model. Instead of using their brains and telling me in simple terms why they were doing this, they were relying entirely on what is now a discredited nonsense model. And I think we have to get away from this. We have to actually tell people, so in simple terms, what are all the foundations that lead you to these conclusions? You're telling me inflation is going to, let's say, pick up or hit these levels. Why? In simple terms, why? You know, spell it out. Same growth, same with everything. And I think that's where, for me, these courses are very important because they give you the foundations to ask the right questions, to actually ask not only the right questions of others, but also of me, you know, and I think that encourages much more constructive discussions than, yeah, I got this forecast, he was a Harvard economist. Tell me, how many times have Harvard economists been right? Okay, I don't mind actually giving you $1,000 for every Harvard economist that has been right, because they've never been right, you know? Which economist has ever been right? They generally specialize in being wrong. I'm no different. The difference that I want to bring into this discussion is that we need to have some foundations in order to make sense of what different people are saying. And that's why I was very happy when Niroshi asked me to do these courses, because in a small way, I want to try and get to these foundations so that you don't have to rely on anyone's prognoses. You listen to them, but you know, you get more, let's say, critical appraisal of what different people are saying.
Thanks, Dr. Heshana, are you there?
Yeah, Niroshi. Doctor, this is Heshana. I'm the CPT committee chairman. Actually, 2 weeks back, when we discussed sessions for our members during this period, I said, Niroshi, if we are talking about global economy, we somehow need to get Dr. Howard. Because I still can remember way back in 2015, you did an excellent presentation for around 2,000 chartered accountants at our national conference at PMIS. So I still can remember that. So thank you very much. Doctor, accepting our invitation with short notice, but there was so much of thought-provoking things that you discuss, and we are looking forward to have intellectual stimulation with future courses that CS Sri Lanka is introducing. Again, thank you very much and stay safe.
Thank you very much. The pleasure is all mine. Thanks, everyone. Safe being to all of you. Bye-bye.
Thank you, Doctor.
Bye.
Thank you.
Thanks.
Bye.
Thank you, all the participants as well. Thanks.
Thank you.